A very good afternoon, good morning. Welcome to our live trading workshop with myself, Giles Coughlin. Hope everybody's doing well. Just looking forward to taking us through the session. Now, there's quite a lot for us to cover, so I will be jumping into things now so that we, are really clear on where we're at. If you could just let me know you can see my screen and hear my voice, okay, that will always be appreciated. Just going to run through what's going on here with the latest geopolitical risk, as well as the running through what's happened with the RBNZ rate meeting. It's been quite interesting, the New Zealand dollar recently, and good to start to see it moving in line with its macro outlook. So there's a lesson to be learned there, which will
just go back to the Ukraine situation, well. German governments.
So without further ado, let's get stuck into the session. Now, don't forget to talk about different entries, exits. The whole idea is this is an educational perspective, so you're looking over my shoulder. Someone with a professional trading background, and you see how about making trading decisions. And the interesting event for us to trade today is the RBNZ rate meeting decision. Now, we did look at the New Zealand dollar, Japanese yen last couple of weeks, and that's starting to play out nicely now. So I'm just going to go over that and particular ways we can enter and what we can do to take advantage of that, and where risk can be defined. Now, first of all, remember, markets are sort of at the moment sort of struggling with the geopolitical risk. So we've seen stocks fall on geopolitical risk. Volatility here in the VIX, you can see, anytime the VIX sort of goes above that sort of 34, 35 region, then that's a warning sign. Now, at the moment, risk is elevated. See, the VIX is elevated, but it's off the highs. So markets are feeling reasonably confident that this latest geopolitical risk can be managed. And one of the key things that you need to be aware of is geopolitical risk in the stock markets has far less of a reaction than you may otherwise expect. So remember, on the blog.HYCM Lab, we go through this phenomenon, and you can see all these big events that have taken place over the last 50, 60 years. You notice that sometimes the stock markets actually recover within the very same day. So, if you look at like the, say, you're looking here at London subway bombing, S&P 500 was actually higher on the day. Yom Kippur War, higher on the day. Suez Crisis, higher on the day. And the events that seem to have the biggest impact are events that are totally surprising. So the Pearl Harbor attack, so obviously that brought the US into the Second World War. So we expect to have that huge impact on the S&P 500. But you can see it recovered, in less than a year. And even the September 11th terrorist attacks, yes, it was an 11% fall in the S&P 500, but the S&P 500 recovered in a month, okay? Just over a month. So often the recoveries are much quicker than you think. So you can see on average, markets recover in 50 days, the bottom's in 22 days, and the total drawn is minus 6.1%. So that means, generally speaking, it makes sense to buy the dips. So at the moment, markets are kind of relieved because the impact between Russia and Ukraine seems to be contained. What has President Putin done? Now let me show you what's going on here, and just so you can understand, let's look at some images of this. There we go. Right, let's right. Now let's just, okay, this is not the best image, but this will actually, let's try and get a better image than that. Let's see if that's a bit better. Right, there we go, that's better. Right. Now what's going on here is Russia really don't like having NATO members on their border. So you can see with Estonia, Latvia, Lithuania sort of joining NATO, the problem is that NATO has a clause, it's called I think it's Article 5, the clause of collective defence. So in other words, if one NATO country is attacked, all will defend the other countries. So that means that Russia would be very, very reluctant to attack a NATO country, because if it attacks a NATO country, it's attacking all, you got Britain, you got France, Italy, Spain, Poland, Germany, Norway, all attacking you as well. So Moscow doesn't want that. So what Moscow doesn't want to have is NATO continually moving towards its borders. It hates it, right? Really hates it. So Moscow does not want the Ukraine to join the NATO. Now, some members of Ukraine want to join NATO, obviously. So you see, Moscow think, oh, if Ukraine joins NATO, then all of a sudden our borders are with a NATO country. And if we make any incursions into Ukraine, then, oh my goodness, then we are triggering Article 5, and it's a security issue from Russia's perspective, right? Ukraine are torn. They want to be part of NATO, many of them, but some of them are sympathetic towards Russia and are pro-Russia. As is often the case, is when you are in an Eastern European country, you've got Ukrainian, you've got old Russian ties, you've got a natural gravitation towards Moscow, because Moscow is much closer than, say, London or Paris or Berlin. So there's a pressure, you see what I mean? Just the social pressure, you're torn, which way do you go? So Ukraine struggles for that reason. So what Russia has done, they've taken some elements of Ukraine that were pro-Russia anyway, and they're saying, they're liberating the regions, but make no mistake, it's an invasion, all but in name. Now the question is, if it stays as it is, and if Russia just take the little pockets of Ukraine that they've got, the Donbass region, and they just take the other region, and they say that's it, and the Western sanctions are in place, everything should carry on as per normal, right? And markets are risk positive today because they're expecting that. But if Moscow goes one step further and makes a move to Ukraine, makes a move to Kiev, then we can see risk elevate. So at the moment, the geopolitical status is relief. Okay, so we're seeing a little bit of upside in stocks, as we'd expect. We're seeing copper prices above the pivot point for the day. Gold prices are pushing lower because there's been a bid into 10-year yields, you see? And as the bid comes into 10-year yields, right, that's just allowed gold to pull off its recent highs. So, as not bid into 10 years, but as the yields rise of the US 10-year yields, see when the because inflation is remaining where it's at, when yields were dropping, okay, that was allowing gold to move higher because bids were coming into the bond market. So if we saw bids coming to the bond market again, that would give gold reason to break above that 1910. As it stands, it's being contained underneath that major resistance. I would expect that to remain the case if the 10-year yields keep rising in current market conditions. Looking at Bitcoin, Bitcoin has been trading as a risk asset, and so with Bitcoin rising higher back up towards that 40,000, that's positive for risk. Nat gas pretty much flat, despite the concerns that we have about European supply. Just turn this into the daily chart. You see that the bids have been coming into yields. So bonds have been sold off. So yields are moving higher again. And you see the risk currencies are soaring. Aussie yen, Aussie Swiss franc, New Zealand dollar Swiss franc, New Zealand dollar yen, CAD yen, CAD Swiss franc. Now, the reason for the good upside in the New Zealand dollar is the RBNZ rate meeting. And this is what we're going to be looking at now. Now, there is a tradable opportunity here, but there are risks, and let me just run through them with you. Now, in November, The RBNZ became the most hawkish major central bank in the world, and you wouldn't have thought it from the reaction in the New Zealand dollar. The New Zealand dollar just fell lower and lower and lower. Now, heading into this event on the blog, I was mentioning that this could be the perfect time for the New Zealand dollar yen to start gaining again. Okay, so you can see start of the week, and looking into the 16th of November, we're looking at New Zealand dollar gaining for the for the various reasons. And I was looking trading the euro New Zealand dollar. You would have seen it on the blog. Okay, now the New Zealand dollar has been gaining, and now we have had a significant shift from the RBNZ. I'm just going to run through it with you. On the left-hand side, this was the projections from November. These are the projections from last night's meeting. So you can see growth was expected to be 0.2, 0.4, 0.3 in 2023. It's now revised to 0.5, 0.5, 0.6. So growth has been revised up higher. The annual inflation has been revised up higher. Look, from 2.9, now it's expected to be 3.2, 2.5, 2.6, 2.3, 2.5. So inflation expectations and following into the next year have all been revised higher. So growth higher, inflation higher, and look at the OCR, that's the interest rate, have also been revised higher as well. Look, it was expected to be 2.6% in December of next year. Now the RBNZ projecting 3.3%, so 60 basis points move, and the terminal rate they're expecting at 3.4% for 2025. And you can see here in 2024 it's what, 2.6. So growth up, inflation up, interest rates higher. Now during the meeting, the RBNZ Governor Orr said that the RBNZ may be moving up in larger increments. So in other words, yes, they had a 25 basis points last night, but they're prepared to raise larger increments. And the members of the committee, a number of them, favoured a 50 basis points interest rate hike. Now, that is a much more hawkish tilt that the RBNZ has made. So as a consequence, New Zealand dollar gains, particularly against the yen, makes sense. Now, let me explain to you why. Look, the Bank of Japan have got two issues. One, inflation remains very low in Japan, some of the lowest inflation in the world of the major central banks in Japan. So they're not pressured by high inflation right now. Also, notice on the monthly chart, you see this band plus 0.25 to minus 0.25. The Bank of Japan has said they're going to buy unlimited bonds to keep the yield underneath that level. So they're not going to allow the 10-year yield to move higher. Now, rising yields is followed by currency trades because it means rising interest rates. Can you see the yields in Japanese bonds? It's 0.19. Now look, it's nearly 2% US, 2.8% in New Zealand, 2% in Canada. It's positive now for German bonds. Australia bonds 2.28. So what you see is a massive rate divergence is really setting up now between New Zealand and Japan. Now, let me just show you this on my screen. So that means that this outlook for the New Zealand dollar yen remains very much tilted to the upside, right? Now, I'm going to put the bond yield spread here on the chart. Now, so we'll look at the New Zealand 10-year, Japanese 10-year bond yield spread. Now, this is really the risk profile for the currencies. And you see how when the bond yield spread moves higher, when the New Zealand 10-year bond yield spread moves higher in relation to the Japanese 10-year yield, that means that's a more positive outlook for the New Zealand economy, right? And you see how price has been tracking it? Now, look at this. We've seen a divergence, haven't we? Because what we've been seeing recently, we've been seeing the bond yield spread pushing higher, right? But the price moving lower. Now, this is why I've been so bullish on the New Zealand dollar yen, because we're expecting price to move up to the yield spread. Why? Because we've got that interest rate differential now between the bank. Like the Bank of Japan is expected to keep interest rates at then very low rates for the foreseeable future. The RBNZ, well, they've just said they're going to be raising interest rates significantly. So that means there's a potential carry trade opening up back again and get to New Zealand dollar yen. Okay, and the bond yield spread pushing higher. Now, before you think this is the best trade I've ever seen, there is a problem, and the problem is, you see, when the yen gets bids on geopolitical risk and risk-off trading, the yen finds bids. So that's why, even though the yield spread was moving higher, the New Zealand dollar yen moved lower. So that's a risk. So if we saw further escalation of geopolitical trouble between Russia, Ukraine, any more Omicron concerns, anything that just hits risk, you see the yen bid. Same with the Swiss franc. And when risk is really bad, same with the US dollar. So over the medium term, we're expecting this pair to gain, but there may be some ebbs and flows. So it means, where can you enter? Well, we were looking at entering, weren't we, when price was down at these sort of lows here, right? Now price has moved high. So what do you do if you've missed that? Well, what you can do, you can still find an entry. You're just going to be clever about where you define and limit your risk. Now, what we have here is a potential opportunity to enter any retracements lower. It's even possible to enter at market with stops just below 76.50. And this will be a medium-term swing trade looking for a move back up towards sort of 80 as a first port of call, okay? So it's not a great risk reward. The favorable option would be any retracements lower. But anything back down to 77.50, 77.60, stops underneath 76.36, looking for a play back up towards 79.50. Now the risk with this is if there is a Russian incursion or a Russian full-on invasion to Ukraine, then we see the yen bid and you're likely to get stopped out. So you just have to be aware of that, but there has been a hawkish tilt from the RBNZ. So looking at New Zealand dollar strength medium term makes sense now. Right, with that being said, let's also now, and if you were like short Euro New Zealand dollar, you can just see, look, moving into that region, like just stops above 1.6844 makes sense now. And that should hold. If any retest up to that level, you expect to find sellers. So any retraces back up to 1.6800, you expect to find sellers in the current environment. The other point to note is that we have the Reserve Bank of Australia meeting next week. So we'll look at that in more detail, but the wage price index was very important this week because, and we looked at this on the HYCM blog. So always look at trading insights, look at trading calendar events, look at that under the blog HYCM, and you can see that this was a key risk for the RBA to hike rates. You see that, like, they basically said that if the print comes in above 2.4%, then expect the Aussie yen pair to race higher. Now the Aussie yen pair's raced higher anyway. Even though the wage price index was 2.3. So it was the minimum expectations, but 2.3% was the reading. If it came in sort of 2.5%, you can expect the Aussie to absolutely surge. Why? Because if prices for wages increase, that impacts inflation expectations. So the RBA sort of said, well, look, we're not convinced that inflation is going to be in our target 2 to 3% sustainably. We want to see wages move higher first and foremost, okay? So this is their wage price index, right? And you can see, so it's still coming at 2.3%. So that is the highest reading, right? It equals since about 2014, 2018 highs, right? 2.3%, so it's there. Now, if you drew a trend line across the top there, that's a trend change in the wage price index. So wages are pushing higher. The only downside to this is that Australia's opened its borders again. So that means there's more competition for jobs. So that puts pressure on wages lower. But you can see here that 2.3% is still pretty good. Now, the RBA meet next week. So I wouldn't be surprised to see some Australian dollar buying into the RBA rate meeting. Now, I think it's probably a bit too late to get on that boat, but if risk sentiment remains positive, you can still see a case for further Aussie yen upside heading into that event. Okay, we are approaching some key sort of trend lines there in the Aussie yen. You can see again the bond yield spread surging higher. Do you see? Because remember what's happening. The Bank of Japan is saying we're going to keep yields lower, so this yield spread has to move up higher, right? And you can see, like, the other times when it's, when it starts to surge higher, look, the Aussie yen pair finds it. So, a move up to 85, 86 makes sense. This trend line could be a good place to find limit risk. If we break above that trend line, stay with it, get back below, get out. Any retracements back down to that 80, 81 region remain, really good opportunities to potentially buy. Okay, folks. So the only final thing to say is that if the geopolitical risk fades, any dips probably are likely to find sellers again as they move higher, because straight away what will come into focus is the tightening by the Federal Reserve. And remember, the Fed is expected to have an aggressive series of rate hikes. And that's why stocks have been falling since the start of the year, because the Fed's expected to be more aggressive. If the Fed's hiking interest rates as growth is slowing, that means companies' profitability will be hit because people are paying more for their mortgage payments. People have less disposable income. Companies find it harder to borrow money from financial institutions. Profitability gets hit, so stocks fall. Now remember, that will come back into focus, even if we see a little bit of dips being bought, and that will quickly be the focus. Now the area where the Fed will get worried and change their policy is if we get a fall of about sort of 22% in the S&P 500. So at the moment, you can see that the Fed are quite happy to see stocks around this level and to see them even lower. But the area where they won't be happy to see it lower than is around that 3,700 band. That's because from a historical perspective, when stocks fall about 22, 23%, you almost always get a recession that follows. So that level that I've marked on the chart, about 23, 22% fall, is the level to be looking at, okay? So watch out for that. With that being said, it's all about the New Zealand dollar at the moment, but managing risk and making sure that that's managed carefully. Okay, I'm just going to go to the chat box, see if anyone's got any questions. Don't forget that coming up next week, we have the Look Ahead webinar. And on Monday, I'll look ahead the key events. So we've got a few key events coming up. We've got Bank of Canada interest rate meeting, Reserve Bank of Australia interest rate meeting. So don't forget to, I think we've got the inflation data out for Europe as well. So a lot of important events come along on Monday. Will help us get ready for those events. Okay, folks. Just going to see if there's any questions, anything in the chat box. Okay, folks, been a pleasure as always, and take care, trade well, and I look forward to seeing you again next week. Thanks everyone now, goodbye.